If you bought your house in the last few years and have an FHA loan, this video is going to be for you because today I'm going to talk about a little known thing that we lenders refer to as an FHA Streamline Refinance. I'm going to discuss how it really works with general eligibility requirements, misconceptions about the FHA Streamline Refinance, how to refinance your FHA loan responsibly with some key considerations, and an example of a $500,000 house and a little thought about tactic to pay off the house faster. A lot of people overlook when doing these FHA refinances. So let's dive in. Ray from the Mortgage Maestro Group, and here we go. First and foremost, what are the general eligibility requirements if you're going to do what's called an FHA Streamline Refinance? Well, let's back up first. Let's talk about what the hell is a streamline refinance. Okay, there's different types of refinances with FHA loans. I'm specifically going to talk about streamline refinances. So, no appraisal, no income documents, no assets unless you're bringing more money to closing than the amount of your payment, no employment verification, and in today's day and age, we can even do these without a hard credit pull. So, a lot of great benefits there, but there are some requirements. Let's talk about some of those requirements. First and foremost, you have to have had this loan for 6 months. And for the next FHA, what's called case number assignment, you're talking 210 days. So really think about it. Since closing 210 days, it's, let's be honest, it's roughly 7 months. But would it even be fathomable? Would it make sense to do an FHA refinance that fast, the streamline refinance in 7 months? Why did FHA do this waiting period? Well, for an old guy like me who's been around, there were people back in the day in my industry that were refinancing people every time rates went down a half, a quarter of 1%, and their balances were just going backwards. So these guardrails put in by FHA are not necessarily a bad thing. They actually will help protect your equity and to ensure that there is what's called a tangible benefit. So let's kind of chat about that. What is a tangible benefit? Well, realistically, you're talking about a 0.5% savings. Now, that may or may not make financial sense. That's going to be the biggest one as far as what you need to see there. But the lender is going to take care of all those technical things to make sure you are eligible. The loan does have to be paid in the month closing. However, as an example, if your loan funded in the middle of a month, you may not have a payment for 45 days because of how interest accrues. So let's talk about some of the myths and misconceptions about these FHA Streamline refinances. If you're doing a no credit qualifying Streamline refinance, you cannot just stuff all these closing costs into the refinance. That's a different type of refinance. This is really geared for a payment and rate reduction. As far as misconceptions, there are closing costs, guys. There are no such things as mortgages. I just saw a Reddit thread with VA loans. And these, I love my veterans. I'm one too, talking about they've never paid closing costs. I've yet to own a business or know of businesses in America with no operating costs. How are there no closing costs? Is a lender telling you this, but the reality is there are closing costs. If you don't have them on the loan estimate, it's because they're baked into the interest rate, guys. You can always get a low rate, pay those closing costs. So a common misconception would be that there are no closing costs. That is a mistake. If a lender is selling you that bag of baked goods, it is BS because there are such thing as closing costs, title fees, attorneys in states where there are attorneys, attorney reviews. But this streamline refinance does have lower closing costs. The underwriting fee is typically going to be cheaper. Again, no appraisal, so that's going to save you there. Title fees here in the state of Colorado are going to be what title fees are. You are going to set up a new escrow account depending. Now, if you work with a lender or as a broker works with the same investor where your loan is serviced, they may be able to take your escrow balance and apply it to the new escrow setup. But in most cases, if that does not happen, you will have to have a new escrow account. What does this mean? Well, your current mortgage has an escrow account for future payments of taxes and insurance if you have an FHA loan. So then what that means is that The balance, once the loan is paid in full, will be refunded to you about 30 to 45 days afterwards. So yes, this new escrow amount will be added to the loan amount for the new loan. Don't get lost in the weeds there, though, because if I get a check 30 days after closing, I could lend myself that money, not wrap it into the new mortgage amount. I'm just passing that money through to myself after 30 days. The check comes and what I brought to closing so that the balance did not go up. Okay. Let's talk about how to do this responsibly. You'll want to talk to the lender. You really want to get an understanding of the break even, the financial break even, how long before this refinance makes sense to have done. That's probably the biggest thing, I think. And getting within that, I mean, if it's going to be a 3-year break even, what if you're going to sell the house? Yes, that lower rate may sound attractive, but it may not make sense to do this refinance. So have the lender explain to you what I refer to as a no closing cost. It's not that they don't exist. It's through the interest rate being slightly higher where they could pay the admin fee. They could pay those title fees for you. You might just have a slightly higher rate than the rate where you pay the cost. But that's just a financial equation then of, did it make sense? Should you have taken A? Should you have taken B? Good lenders will take the time and educate you about all of these things. So I think from a responsible sense, it's always best to take the rate where the closing costs are credited on your behalf, especially in a market cycle where rates are going to be coming down as they are now. Something to be thinking about, but talk to the lender about this as well. Other things, as far as key considerations go and what you want to be thinking about, is when you bought that house with that FHA loan, there was that 1.75% financed mortgage insurance premium. Now, within the first 36 months, there's a prorated amount that would be refunded as a principal reduction towards your existing loan. Upfront mortgage insurance premium refund. However, after that time, if you've had this loan more than 3 years, there is a new 1.75% upfront mortgage insurance premium stacked onto the payoff of your mortgage. So understanding that, having the lender explain to you how this is going to apply, because that could change the new balance and therefore the actual true monthly savings for you as well. Reasons to think about this is if you bought in the last few years and had a temporary buy down, and let's say your interest rate note rate is 7.5%, but you're still sitting at, let's call it 5.5% on the payment right now. Could it make sense? Yes, you would forego some of that initial savings you're still going through with that temporary buy down, but you would be fixing in your rate permanently at a lower rate. So this is all a debate. This is where the education comes into play. But let's get into a real life scenario here about a $500,000 mortgage, okay, with a rate at 6.75%. Now, mind you, this is all just for educational purposes, okay? If that loan was able to be refinanced with an FHA Streamline Refinance to 5.75%, that 1% reduction would save about just over $300 a month. The irony behind this is the interest you would pay on that mortgage at 6.75%, now cover your ears, would be about $679,000 over 30 years. I know that's crazy. If you took the $300 a month savings, closed on the new loan with a 5.75, and you took that savings and applied it to the new loan, the 5.75 rate, and you sent $300 a month, so you're making the same payment you're making today, you will pay $427,000 of interest making the same payment you're making today just because you lower the rate by that 1%. More so than that, you would actually pay the house off in 24 years. Not that you're going to own the house for 24 years. However, please be mindful that if you sell the house and someone else pays it off, you will still have a lower payoff if you sent the $300 a month to the principal as a reduction. Another thing I do want to share with you, a lot of people overlook this. And before I get into that, check out other videos that I have here about FHA loans. If you're self-employed and looking to get an FHA loan, I have a video for you about that. and videos on closing costs and really understanding what truly is going on in the loan estimate as well. If you like these kind of educational videos, make sure to subscribe to my little channel. Thank you so much. Let's chat about those couple overlooked things. I see people oftentimes talk about break evens. If the closing costs are X and my savings is Y, it's going to take this many months. It's a very simple calculation. True and false. What's missed there is if I close on that loan at the end of a month, I'm not going to have a payment for about 30, 35 days, whatever the first of the month following the month of closing is. So what did I do with that skipped payment? It stayed in my checking account. If you want to have apples to apples comparison of costs, break evens, does this make financial sense? Make sure you deduct the skipped payment from the closing cost, because you could have brought that to closing and not stacked that amount of money onto the balance of your new loan. So that's one thing that I see that's commonly not thought about, which is what are you going to do with that skipped payment? And to add to that, what's going to happen to that escrow refund? If you had $3,000 or $4,000 and it came back to you from your escrow account after the loan is paid off, 30 to 45 days after closing, what did you do with it? It was cash created, just like that skipped payment was. You could have lent yourself the money from your savings and reimbursed yourself when the check came back, and then not added that to the payoff for the new loan to close as well. So those two key components, I think, are highly overlooked. But if you really want to get into a true break even, I kind of think you have to analyze it with those two numbers included. If you have specific questions about your FHA loan or any other type of loan you're thinking about refinancing right now, hit me up, schedule a consultation, calendly.com/mortgage maestro. Drop in the comments what type of videos would really help you as you learn to grow more wealth through real estate and your mortgage. Upcoming videos that I'm going to touch on, I'm going to go through a VA refinance, and I'm going to talk about how to qualify with rental income for your next home if you're going to make this home a rental or have other rental properties. Be well. We'll catch up with you soon.